Good morning, everyone. Welcome to today's session. So we are kicking off with inventory systems. We're going to just recap what we did last week and then, or the previous week, and then we're going to do a practical question to just build on our foundation. Then in the second and third session, we're going to focus on Learning Unit 7, which focuses on debtors and creditors. And then in the fourth session, we will focus on salaries and wages and the basics around that. So just to quickly discuss what is the learning objectives of this learning unit. So you need to be able to explain a business why someone of them would choose to use the perpetual inventory system or not to use the perpetual inventory system, but rather a periodic system instead. Now remember, the main difference between the two is a perpetual inventory system is a just in time. So we know exactly at any point in time what inventory we have on hand, whereas a periodic system, we only know how much inventory we have on hand once we finish the stock take, normally at the end of the year. Now, the periodic inventory system is a lot cheaper to do, so small businesses would prefer doing periodic versus perpetual is more for your bigger businesses, where it is, because it's a very expensive system, your bigger businesses would normally use that needs to know exactly how much stock they have at any point in time. Then you need to be able to calculate the cost of sale using your periodic inventory system, and you need to demonstrate the working of the purchases and purchaser return account and the periodic inventory system, and demonstrate the working of the carriage on purchases and similar accounts that affect the calculation of your cost of sales under the periodic inventory system. So you'll see this learning unit focuses more on the periodic inventory system, whereas learning unit 2 focused more on the perpetual inventory system. Then you need to be able to analyze inventory related transactions in your accounting equation, and as well as recorded in your subsidiary journals, and then explain which one of the two inventory systems is the most desirable in the world we live in. Okay, so that is the learning objectives that you need to be able to achieve once you've completed the work in this learning unit. Now let's quickly recap what is the difference between your periodic and your perpetual inventory system. Now when you purchase inventory under your perpetual inventory system, you would actually take the inventory you purchased to an asset account, the inventory account, and your equity, owner's equity, would remain unaffected. Under the periodic inventory system, we take it directly to your purchases account, which is an expense account, and that actually reduces your owner's equity. Okay, so you can see the difference in the purchase. Under perpetual, we take it to an asset account, inventory, whereas under periodic, we take it to the purchases account, which is an expense account, which affects our owner's equity. Then once we sell inventory, this is where the main difference comes in. Under the perpetual inventory system, we have two double entries. So we've got an entry for the sale, and we've got an entry for the cost of sale. So we work out the cost of sale every time we sell the goods to a third party. Whereas under the periodic inventory system, we only show the sales transaction. We only do the cost of sales transaction at the end of the year when we do a stock take. So that is very important to note. And this is one of the big areas where we normally catch out students if they do not know the difference between the two inventory systems. Then any additional costs incurred, so under your perpetual inventory system, those additional costs also gets taken to trading inventory. As long as those costs bring that product to its current condition and location in order to sell it, then it will be captured to trading inventory, otherwise it will go to the normal expense account. Whereas under the periodic inventory system, we take it to the individual expense account. So if we've got import duties, you take it to the import duties account, purchases goes to purchases, and so forth. And it does not go to your cost of sales. The cost of sales will remain unchanged at that point in time. Then trading inventory account, your perpetual inventory system, that trading inventory account gets updated every time something happens. So we've got a constant working balance. We know exactly what the stock is. Whereas under your periodic inventory system, the trading account remains unchanged until year end when we do our stock take. Then we only update it, and then we only record the cost of sales at the same time. Then cost of sales, we record the cost of sales under the perpetual inventory system when we sell something at a point of sale. Whereas under the periodic inventory system, we record it when we do our stock take at year end. Then we only calculate our cost of sales using the formula that you guys learned in the previous session. Now, talking about the previous session, this is the formula that you would use to work out the cost of sales under the periodic inventory system. So you start with your opening trading inventory, then you add any purchases less any purchase returns, you add any carriage and railage freight on purchases, and then you add any import tariffs and you add any custom duties, and then lastly you deduct the closing trading inventory. This will give you the cost of sales under your periodic inventory system. Then we have to be very careful to read what information do they provide us. Are we busy with the initial or subsequent reporting? Because initially you would record inventory at cost, so whatever you paid for it, and then subsequently you would record it, so that subsequently means at year end. So subsequent year ends, reporting date, you would record it at the lower of your cost and your net realizable value. Now, net realizable value, just to recap, is the selling price less any cost that you have to incur in order to sell that product. So basically your market value is what your net realizable value would be. Then just to talk about the general ledger differences between the two. So if we look at the financial method, there will be no difference in your general ledger account for inventory. The difference would mainly come into your nominal account, because under the perpetual inventory system, we will only use cost of sales, whereas under the periodic inventory system, we would use purchases, carriage on purchases, custom duties, import tariffs, and purchase returns. And remember, we would account for each one separately, and then only once we've done the stock take at year end will we then take these amounts and write it to cost of sales, or to work out the cost of sales amount. Now, what we're going to do now is we're going to do a class activity. This is a past paper in 2018, where they asked the students to make use of the periodic inventory system, and they had to take the following amounts into account. Now remember, New Yorker Stores is a registered VAT vendor, and we're required to do the inventory balance and purchases of the general ledger account at month end. So they ask you to only do the inventory as well as the purchases account at year end. So I'm quickly going to just open the PDF. So I'm going to stop sharing this file and then open the question in PDF. Okay, so based on the question, this was question 3. It was 15 marks. So this question should take you 15 minutes in an exam or in a test to perform. So within 15 minutes, you should actually have finished this question. Now, a lot of students actually performed very poorly in this question because of the fact that they did not know the main difference between what is perpetual inventory systems and the periodic one. Okay, so let's quickly look at what vital information that they give us. So the first thing you had to see was that we are dealing with the periodic inventory system. Now, what that means is we need to take the information goes to purchases. Okay, so your expense account. So that was the first thing that you had to note, is that we actually taking it to the purchases account and not to the trading inventory account. Now, we already said what do we have to do. So if we look at the required, okay, so they asked you to balance all the accounts at the end of the month. Now, based on the information below, we can see the accounts are inventory and purchases. So they want us to balance the inventory and purchases account, okay? Okay, so that is what was required from you. Okay, let's quickly see what else they give. The following totals have been taken from the January 2018 journals. Okay, so we're dealing with January 2018. Okay, post the relevant journals to the relevant accounts in your answer booklet. Okay, so we have to post the information they've provided below to the relevant accounts provided in your answer booklet, and we know we are a registered VAT vendor. Now, why do we need to know we are a VAT vendor? So that we know whether we need to include or exclude VAT. Now remember, when we account for any item and we are a VAT vendor, we have to exclude the VAT because we would be able to claim the input VAT on that transaction. Now, just if you quickly scan through this, you can see some of it includes VAT, some of it excludes VAT. This is very important to note in order to complete your account balances. Otherwise, you will get the incorrect information. Okay, so what we're going to do now is we are going to first go through the information, see what information have they provided to us, and then we are going to complete the ledger accounts that they have provided. Okay, so with the first information they've provided, if we go to the answer booklet, they've given you an inventory, they've given you the inventory account, and they've also given you the inventory account and the purchases account. Now I'm going to complete this on this answer booklet that was provided so that we can have the information as we go. So the first thing you had to do is you take the opening balances. So that's your opening balances in your account. So we know that the opening balance on the 1st of January for inventory was 60,000. Now remember, inventory opening balance would be on the debit side. So we say here balance. Okay, it's on the 1st of Jan. So we type in 1st of January 2018. Let me just enter here so it doesn't fall over lines. Okay, so 1st of January, and the folio number would be brought down. Okay, and the balance here would be 60,000. Okay, so that is just the opening balance for our inventory. Let's quickly see what was the opening balance for purchases. So purchases opening balance was 293,750. Now remember, purchases and expense. Expense is will be debited. So our balance here would be on the 1st of January. We would have a balance brought down. $293,750. Okay, so this is just accounting for the opening balances. Now let's look at the rest of the information that was provided to us. Okay, so the total cash purchases So if we look at total cash purchases of inventory, now because of the fact that we have the periodic inventory system, we know that purchases of inventory goes to the purchases account and not the inventory account. So this is what I've said here at the beginning. If you missed that, you would have taken this to the inventory account and you would have completed the inventory account, whereas the purchases account is actually what you need to complete. Okay, so cash purchases, your journal is CBP, so your cash book payments. But then very important to note is this amount is inclusive of VAT. Now we said if you are a VAT vendor, you have to exclude VAT from that amount. So I need to take out the VAT component in that section before I can actually capture it to the purchaser's account. Okay, so let's then go capture the information in our answer booklet. So the first thing, we have our bank. So purchases would increase this. So where did it come from? Our contra account is our bank account. Okay. Then what is our folio number? Our folio number is cash book payments. Okay. So we've got it from our cash book payments. But now we said that this amount, the 110,580, is inclusive of VAT. So it's 110,580. Now, in 2018, the VAT rate was 14%. So for this solution, we are going to use divide by 1.14, or you could have done multiplied by 100 over 114, and you would have gotten to the same answer. Okay. Okay, and that would then give you an answer of 97,000. Okay, so for that one, you would have received a mark for the bank and the correct folio number. You would have received a mark for excluding the VAT, and you would have received a mark for the correct answer or your calculation thereof. Okay, so let's see what the next transaction is. Credit purchases of inventory. Okay, so now we purchased it on credit purchases. So CJ, and this is excluding VAT, so I can take the amount as is to our account. Now, when we buy something on credit, the main account, it would be creditors control. So our main account here is creditors control. Our folio number is CJ. Okay, and we know that the amount based on this was 85,500. Okay, so 85,500. Okay, so there we've done the first three transactions. So for this, you would have received the mark for your creditors control and your CJ, and you would have received a mark for the 85,500. Then if we go to the next one, we've got total purchases returned. Okay, so purchase returns. Okay, now the question here is the CAJ. Is the purchase return the same account as purchases? Now, when we spoke about this or we recapped this, we said that purchases and all the different other accounts have separate accounts. So based on that discussion, do you think purchases return would be captured under our purchases account? Okay, so let me just repeat the question. If we look, we only have to complete the inventory and the purchases account. Would the purchases returns be captured in our purchases account or not? Yes or no? So guys, what do you think? Will any purchase returns, will it go off our purchases account? Yes or no? Okay, so the answer is actually no. So for this one, we will not show the purchase returns in our purchases account. And the reason for that being, in the periodic inventory system, we actually account for each expense or return separately. So each one has their own account. So we would have a purchases return account, a separate one, a separate general ledger account where we would actually account for it. So for that transaction, it would actually not appear in our purchases. So this would be captured in purchases return or returns, BL, and not in purchases. Okay, so this is very important to note, the fact that the purchase returns will not be captured in our purchases, but it will be captured in purchase returns. Okay, then if we look at the next one, the owner took inventory for their own use. So this is a general ledger account and it excludes inventory. So normally if we under the perpetual inventory system, we would actually credit the inventory. But because we're busy with the periodic one, we would now have to take it to purchases to reduce our purchases amount. So what we're going to do is we are going to credit purchases with the 6,612. Okay, so that was, sorry, let me just put in the dates here for this side, 31st. Okay, so on the 31st of January, when an owner takes something, we take it to drawings. The folio number is general journal, and our amount is 6,612 Rand. Now, the mark allocation, you would have received a mark for the drawings in the general ledger, and you would have received a mark for the correct amount. Okay, let's look at what was the next one. Inventory taken by the owner was returned. So a portion of the inventory they've taken, they've now returned. So that means we have to reverse a portion of that entry that we've made, and this is also excluding that. So if inventory is returned by the owner, it means our purchases amount will increase again. So this transaction here, a portion of it will get transferred to the debit side. So we take it to the same account, so drawings account again. Our folio number is the same, so it's general journal. And the amount that we have returned was 612 Rand. Okay, so we capture the 612. So you would have received the mark again for drawings and general journal and 612. Okay, let's see what other information. Total carriages on purchase. Okay, will carriages on purchase be captured to your purchases account? Yes or no? Will the carriage on purchases be captured to your purchases account? Yes or no? What do you guys think? Maseko, Saliwe, what do you think? Will you capture carriage on purchases to your purchases account? Okay, so similar to our purchase and return general ledger, the answer would be no. Carriage on purchases would also be captured to their own separate account. So we will not capture it to the purchases account. I'm just going to put it here at the bottom so that you guys have the notes. So this will be captured to your carriage on purchase. General ledger account and not in purchases. Okay, so you should not show this amount anyway, or not in the accounts that they've asked for. Then the last entry that we've got is they tell you that there was a settlement discount received from our creditors on inventory purchase. Now, similar to the perpetual inventory system, if we get a settlement discount when we purchase inventory, we have to reduce the inventory amount. So in this scenario, we would then have to reduce the purchases amount with the discount we received from the creditors because we haven't actually paid that amount for the inventory or at the end of the day. So to make sure that we have the correct cost of sales at the end of the day, we have to reduce the purchases. So we will then capture this on the credit side of our account. We will take it to, because a creditor gave it to us, it will go to creditors control. That would be your main account. Now, because of the fact that settlement discounts only happen once you do payment, this would normally be a general journal. And then the amount that was provided to us is 3,500. Okay, now the last step, if we look at what they've asked you to do, let's quickly see, is, let's just make this like that so we can see it. So they asked us to balance all the accounts at the end of the month. Now let's quickly look at the two accounts. So the first one is inventory. Okay, we did not have any transactions, so the balance is 60,000. For purchases, we've got entries on the debit as well as the credit side. So in order to balance this, we need to go sum the left-hand side because that's the biggest side to get an amount. Now, if you add all of those amounts together, you should get to a value of 476,862 Rand. Okay, which we then transfer to the other side. Okay, so we've got the 476. Now, you can see from the information above that we've only got a 6,000 and 3,500. So this is clearly a lot smaller than the 476,000. So we will have to balance this account. So you write here balance, carry it down, and then we fill in the difference. Now, if you deduct those two amounts, you should get to 466,750. Okay, that's what you should get to. Then the last step you have to do is this balance that you've balanced now, you have to carry it over to the following month because that is how you balance the account and you get a mark for carrying it over. So it is 1 Feb. And this is important that you add the date because otherwise you have not balanced it properly. And then we are going to use the same information as up here. So you have your balance brought down. And the amount is exactly the same as here. So you get a method mark. So if you made a mistake in this account, by still balancing it, you still get a mark just for balancing it, even though you did not get the correct amount. Okay, and that is how you were supposed to complete these accounts. Do you guys have any questions on what we've just done? Any questions on completing of these two accounts as per the 2018? I think this was a test, if I remember correctly. Do you have any questions on this? Okay, do you have any other questions on Learning Unit 6, so inventory as its own? Do you have any questions on inventory? Is there anything in inventory that I need to re-explain that you guys do not understand?